Hello everyone, welcome to Brilliant Bankers. Today in this session on the facilities for importers and exporters, we will be going through the chapter of the heading the Gold Card Scheme. So what is a Gold Card Scheme? It was a scheme that was launched in the year 2003-2004. It was exactly not launched, it was announced by the government, that is the Ministry of Commerce and Industry, in the year 2003-2004 to launch a gold card scheme for the credit worthiness of the exporters, to provide a special facility for a creditworthy exporter who is having a good track record for having easy access to the export credit of best terms. The RBI has drawn up a gold card scheme for this purpose so that the scheme envisages certain additional benefits based on the record of the performance of the exporters. The gold card holder would enjoy a simpler and the more efficient creditworthy delivery in recognition of their good track records. So what happens in this? It is to simplify the access to a bank credit for exporters. The Reserve Bank of India launched the scheme so that it provides preference in providing packing credit in foreign currency and term loans in foreign currency to the deserving exporters so that they don't have any problem in their export and import trade. So, what are the objectives of the scheme? Depending on the track record and credit worthiness, the gold card holders or the gold card holder exporters were granted or are being granted better terms of credit, including interest rates, than those extended to other exporters by the bank. The credit applications will be processed at norms simpler and under a process faster than the other exporters. The in principle limits will be sanctioned for 3 years with the provision for automatic renewal to fulfillment of terms and conditions of sanction. So normally the gold scheme card, gold card scheme is for 3 years. The tenure is for 3 years, and if they are completing all the terms and conditions, then the renewal will be done for a few 3 more years. The gold card holders will also have a preference for packing credit in the foreign currency. If their track record is on the timely realization of the export bills, these gold card holders will be considered for issuance of foreign currency credit cards for meeting urgent payment obligations also. The charges schedule and the fee structure in respect of the services provided by the banks to exporters under the scheme will be relevantly lower than those to the other exporters, since the bona fide of the gold card holder is already established based on the credit worthiness and the track record. This is something like that of CIBIL of a normal individual. The norms in respect of the security and the collaterals may be relaxed while granting export credits under the gold card scheme. The banks may consider other facility or benefit to the exporters subject to the fulfillment of the exchange rules and regulations to the export facilities also. There are some criteria for issuing the gold card. The main criteria is that all creditworthy exporters with good track records will be eligible for a gold card scheme. Exporters with a minimum track record of 3 years, which is continuously standard with no irregularities or adverse features, will be treated as having a good track record. Exporters blocked by the EGC, included in the RBI defaulters list or the caution list, or making losses for the past 3 years, or having the overdue bills over 10% of the current year's turnover will not be eligible for the gold card scheme. A gold card under the scheme may be issued to an eligible exporter, including those in a small, medium sectors who satisfy the conditions. How do banks fix the credit limit in a gold card scheme? Considering the exporter's anticipated export turnover, always we are going for the export turnover. The bank can provide need-based business loans with a liberal approach. The in-principle limit will be sanctioned for 3 years for automatic renewal of the fulfillment of loans terms and conditions. The banks would give a golden card holders preference for granting backing credit in foreign currency. Further, banks will consider giving them loans in foreign currency for deserving businesses out of the FCNR funds. The funds can also provide interest concessions with the soft wires towards gold card holders through a transparent mechanism. The processing charges are lower and service charges are at a flat rate of 0.1%. So, what is the rate of interest that is being applied for the same loans? The rate of interest charged under the gold card scheme will not be more than that of a general rate for export credit in the respective bank and within the ceiling limit that has been prescribed by the RBI. So, as discussed earlier, the tenure of the gold card will be issued for a period of 3 years and automatically renewed for 3 years unless there are adverse features, irregularities in the account, in case of misuse of the card, or observance of any violations of the terms and conditions. So, this is what this is simpler and more efficient for the credit delivery. The gold card holder would enjoy simpler and most efficient credit delivery in recognition of their own track record. Next, we will go to the topic export data processing and monitoring system. EDPMS, Export Data Processing and Monitoring System. The Export Data Processing and Monitoring System is an electronic platform that was implemented by the Reserve Bank of India to monitor and process export related transactions. It plays a very pivotal role in facilitating and regulating the movement of foreign exchange associated with the export activities by ensuring that the export transactions are processed in a swift and systematic manner, reducing the time and effort involved in the documentation and the financial processing. It also, by helping in enforcing compliance with foreign exchange regulations, this is very crucial for maintaining the transparency and the integrity in international trade by tracking the regularization and the repatriation of the export proceeds. This ensures that the exporters receive their payments promptly in accordance with the regulatory requirements. The system is further also designed to maintain the integrity and confidentiality of the export related data, safeguarding the sensitive financial information, and also streamlining the export process by automating the process of exportation, export documentations. This reduces manual intervention and minimizes the risk of errors and automatically speeds up the overall process by integration with the stakeholders, by its reporting and monitoring capabilities, by comprehensively recording transactions, by facilitating regulatory checks, and by minimizing delays, bottlenecks, and the risk mitigation process. So let's go into detail on these topics. Integration with stakeholders. How does it? How does the EDPMS integrate with the banks, the exporters, and the government authorities? The EDPMS is designed to seamlessly integrate with various key players who are involved in the export transactions, like the banks, exporters, and the government authorities. With the banks play a crucial role in export transactions as they handle the financial aspects. So EDPMS integrates with the bank system to facilitate the smooth flow of funds, ensuring that the export proceeds are realized and repatriated efficiently. The exporters are directly involved in the export process, and EDPMS provides them with a platform to submit necessary documentations, track the progress of the transactions, and receive updates on the status of their export proceeds. The government authorities, who are the regulatory bodies, are responsible for overseeing and enforcing compliance with the foreign exchange regulations also. EDPMS is integrated with their systems, allowing for real-time monitoring and verification of the export transactions. Automatically, these integrations creates a cohesive environment where all stakeholders can interact with each other, exchange their information, and collaborate efficiently, reducing the chances of errors, delays, and miscommunications, if any. How does it generate reports and the monitoring process happen? That is, monitoring complaints happen. EDPMS generates reports related to export transactions, which include the transaction-wise details, the realization of export proceeds, and the complaints proceed. The transaction-wise details, that's a detailed record of individual export transaction, including the parties involved, the goods or the services exported, and the financial details are all recorded in the process. The realization of reports on the actual receipts of payments from overseas buyers are being recorded, and documentation of verifying that export transactions adhere to the foreign exchange regulations and policies are also checked through the compliance reports. So these reports are crucial for monitoring the compliance with foreign exchange regulations, allowing for audits and providing transparency in the export process. How does EDPMS ensure payment in accordance with the regulation? It plays a very pivotal role in ensuring exporters receive their payments in accordance with the regulation. It verifies that the export proceeds are received through legitimate channels and that they comply with the foreign exchange regulations. It tracks the repatriation of funds back to India, ensuring that exporters receive their payments as per the regulatory requirements also, which helps in maintain the integrity of the financial transaction and safeguard against potential fraud or non-compliance, if any. The regulatory compliances and the process of keeping the data security. In regulatory compliances, EDPMS enforces adherence to foreign exchange regulations, helping to prevent any violations as discussed earlier. This is the vital for maintaining the integrity of the export process and ensuring fair trade practices. Coming to the data security thing, given the sensitive nature of the financial transactions, EDPMS is equipped with a robust security measures, which includes encryption protocols, access controls, and other safeguards to protect against unauthorized access or data breaches. These security measures are in place to protect the sensitive financial information and ensure the confidentiality and integrity of the export related data. Does automation and streamlining of export documents work? Yes, of course. And how is it? How is that done? EDPMS leverages automation to enhance the efficiency of the export documentation process. It allows for the electronic submission and processing of necessary export documentation, reducing the reliance on manual paperwork. Automation minimizes the risk of errors, accelerates processing time, and provides a standardized approach to documentation, leading to a more efficient export process. By automating these tasks, EDPMS contributes to a smoother, faster, and more reliable export process for the businesses and exporters. So, in summary, EDPMS is a critical component of the India's export ecosystem. By automating the documentation, ensuring regulatory compliance, and providing comprehensive monitoring capabilities, it significantly contributes to the efficiency and the reliability of the export transactions, which in turn supports the growth and stock, which in turn supports the growth and sustainability of the export sector. So EDPMS is a comprehensive system that not only integrates various stakeholders but also ensures compliance, security, and efficiency in the export transactions, making it an indispensable tool in India's international trade ecosystem. So the next topic is factoring. Factoring is defined as a continuing agreement between a financial institution, that is a bank, and a business concern selling food or services to track customers on open account basis, whereby the factor purchases the client's book debts either with or without recourse to the client and in relation thereto, controlling the credit extended to the customers and administers the sales ledger. So, what is that? It is the purchase of book debts is central to the function of factoring. So, we can explain this as we mentioned earlier, the purchase of book debts is a central function of the factoring, while credit control and administration of the sales ledger are the other services provided by the factor. We will be going to a detailed explanation how does factoring work. But before that, let's go into a small introduction. Factoring has been a has was having is having a long history that is dating back to several centuries. But it was introduced in India in early 1990s after the recommendation of the Kalyana Sundaram Committee, which was set up by the Reserve Bank of India to examine the feasibility of the introduction of the factoring in India. What are the services provided in factoring? It provides debt administration, that is, managing the sales ledger of the client, saving his administrative cost of bookkeeping, invoicing, credit control, and the debt collection. It saves him from credit protection. As professionals, factors will have the facility for credit intelligence to enable them to access credit risk and advise their clients accordingly. It also helps in factor financing. Financing is an essential activity for the factor. In certain countries, it may not be an essential service. Generally, a factor will be able to advance up to 75 to 80% of the outstanding debt. So, what are the various services that are provided in factoring? That is debt administration, credit protection, and factor financing. So, what is the mechanism of factoring? How does the factoring work? There are a total of three parties that are involved in factoring. There is a bank or the financial institution, the exporter, and the purchaser. The exporter or the business, they sell their goods or services to its customers on terms of credit and an invoice is generated. Instead of waiting for the customer to pay the amount, the business or the exporter, they go to a factoring company, that is a financial institution or what we call a bank. The bank pays a percentage amount, that is around 75 to 80%. Approximately 85% is being paid normally of the invoice amount upfront to the exporter. So in this case, the exporter or the business, they are having an amount of 85% in their hand on the export invoices so that they can start their next production for export. And now it becomes the responsibility of the bank to collect the full amount from the customers when the invoices are due. So the products that are sold on credit, it will be given a certain period, for example 90 days. After selling the product, the exporter goes to the bank with the invoice and hands over the invoice to the bank, saying that the product has been sold and the usage period of payment is 90 days. In this condition, the bank pays almost 85% of the amount to the exporter and informs the exporter that he will be paying off the rest or the balance amount after deducting the interest and the charges on collection from the customer. Once the customer pays, the bank remits the remaining amount to the exporter after deducting the interest and the charges that are applicable on the condition. So this is how the factoring mechanism works. What are the advantages of factoring? Immediate financing of up to 75 to 80% of the invoice. There is no need of an LC. That which saves cost of the cost for the importer. Credit check on the importers and buyers are being maintained. The sales ledger is being maintained, and credit protection on all the approved debtor is under limits and being maintained. The advisory services for new areas and countries are being sorted out by the bank itself. Now coming to forfeiting. Forfeiting is another product of financing of export receivables. So this also works in the same condition as that of the factoring. So always it is mentioned as factoring and forfeiting. So both are a financial export receivables facility. So forfeiting is defined as a mechanism for financing by discounting of export receivables without recourse to the seller for a medium period or on a fixed rate basis for the full value of the contract. So in the case of factoring, it was with recourse, and in the case of forfeiting, it is without. So in the case of factoring, it was with recourse, and in the case of forfeiting, it is without recourse. And what happens in this? The financier agrees to finance the transaction on the basis of the standing of the importer, his country risk, and at times does so on the strength of guarantee of the importer's bank itself. Since forfeiting generally covers medium term financing, export of capital goods, and projects, etc., made on medium term basis are eligible for forfeiting. However, there is no restriction for financing of medium term exports only, as such exports of commodities, consumer goods, where exports are normally made for short periods of say up to 12 months, are also financed through this route. So how does a forfeiting mechanism work? There are a total of 5 parties in the transaction. And what is the process that is happening? An exporter makes a sale on credit terms to a foreign buyer and creates a promissory note or a bill of exchange. Here, the exporter sells this bill or the bill of exchange or the promissory note to a forfeiting company, to the bank. So the financial instrument is being sold to the bank at a discounted price. And the forfeiter holds the instrument until maturity and collects the full amount from the foreign buyer when it becomes due. This is the mechanism of forfeiting. This is how forfeiting works. So, what are the benefits of forfeiting? It takes away all political and commercial risks associated with the export receivables. If in case there is any complication in the exported country or the imported country or the country in which the import takes place, it makes available 100% finance against the invoice that is drawn. It is made without it is a without recourse facility, freedom from credit administration and follow up. So there is no requirement of going for a loan on this facility. Once the bill is solved, it is solved. The whole amount is being taken by the exporter. It's a cost saving measure, as cost saving on export credit insurance and the besides related paperwork are avoided. And the fixed rate financing, there's a freedom from movement of interest rates for the tenure of the bill. So what's the difference between factoring and forfeiting? The major differences between the factoring and forfeiting are, we are only going for the key differences on the nature of transaction. Factoring involves the sale of accounts receivable, and forfeiting deals with the sale of exports receivables, often international trade transactions. On the case of recourse, factoring can be with or without recourse. With recourse, the business remains responsible for bad debts. Without recourse, the factor assumes the risk of non-payment. Forfeiting is typically without recourse, meaning the forfeiter assumes the risk of non-payment. And the types of transaction, factoring is commonly used for ongoing domestic trades, and forfeiting is more suitable for large one-time export trades. Coming to a conclusion, both factoring and forfeiting are valuable financial tools that can help businesses manage cash flow and mitigate risk associated with credit sales. The choice between them depends on factors such as the nature of the business, the type of transactions, and the risk preferences. It's advisable to consult with financial experts on all these things. And as a CIB student, you will be it will be clear for you what and how the factoring and forfeiting works. For factoring is mostly done for domestic transaction, and forfeiting is commonly done for international transactions only. In the case of factoring, you can do both domestic and international transactions. So today, any questions on the video may be updated in the comment section, for which will be published to reply. This is Nishant signing off from Brilliant Bangers. Jai Hind.